Global markets are in a holding pattern as traders wait to see how sticky US inflation is later today. Japan didn't go into a recession, and its negative interest rates might come to an end. And India's CPI is set to hold steady. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim explains how the Reserve Bank of India may have over-delivered in its fight to tame inflation, and how it could already be adjusting to loosen conditions through the repo markets.
We do think that the Reserve Bank of India may be expressing its comfort with how inflation is broadly evolving through the banking liquidity route.
But first, in 5 and 5 with ANZ, markets are treading water ahead of critical US price data out later today. The S&P 500 down 0.2%, after being down 0.4% in earlier trade. While US Treasury yields, they're higher, the 2-year up 4 basis points at 4.52%. At 5 a.m. Sydney-Melbourne time, the Aussie dollar, it's down 0.2% at 66.11 US cents, and the Kiwi down just a tad at 61.70 US cents. ANZ head of G3 Economics, Brian Martin, says traders were trimming positions ahead of the US CPI read.
Fed Chair Powell last week guided that greater confidence is needed in inflation for the FOMC to start cutting interest rates, but that might not be far away. So I just think people really need to see these data to get on board with whether or not rates can actually be cut, say by June, or if inflation is sticky, are the Fed going to be that bit more patient and will just take that bit longer.
Number 2. So it turns out Japan didn't go into a recession in the December quarter after all. A final revision of the figures yesterday turned a 0.4% contraction into a 0.4% expansion, thanks to higher capital spending by businesses. Here's ANZ's head of FX strategy, Marjabeen Zaman.
I guess things don't look as bad as we thought back in Japan, and seeing a little bit of recovery coming back.
Number 3. There is some speculation the Bank of Japan could finally end its experiment with negative interest rates, possibly as soon as next Monday. Marjabeen, however, still sees the BOJ waiting until next month.
We had some reports end of last week on Friday, which really pointed to the possibility of the BOJ hiking interest rates in March, should the wage negotiation phase with unions next week continue to show signs of healthy wage growth. We continue to still think that April is likely going to be the month where they shift, and that's probably because that's the same time they also release their forecasts. And finally, of course, they will have a better picture of the wage outlook in April post the Rengo negotiations.
Number 4. India publishes CPI inflation data for February later tonight. ANZ economist Dhiraj Nim sees a steady headline annual rate of 5.1% and subdued core inflation.
Food inflation's probably still remained elevated, but core inflation quite benign at about 3.5%. However, we may continue to see some underlying improvements in the sense that some of the key items within the food basket, for example, staples like cereals and pulses, it is likely that inflation will have come down, which bodes well for inflation expectations overall.
Number 5. So all eyes are on US inflation figures for February tonight, with the market consensus for a headline monthly rate of 0.4% and core inflation of 0.3%. ANZ's head of G3 Economics, Brian Martin, says the focus is on how sticky inflation is, particularly for services prices.
The supercore inflation in the US in the January CPI was very, very strong. It was up 0.85% month on month, and that's services inflation excluding housing. But when you look at the housing data in January, they were very strong as well. It rose 0.6% in the month, up from 0.4% in the previous 2 months. And we really need to see if this is just a one-off, what we would call menu cost increase, or is there greater persistence in inflation?
Brian Martin there. Now, in our bonus deep dive interview, ANZ economist Dhiraj Nim says the Reserve Bank of India may have over-delivered in its fight to tame inflation. Core inflation is now below the RBI's 4% target. However, it's too early to loosen fully just yet because food inflation is still almost double that rate.
Even though the underlying dynamic of growth is non-inflationary in the sense we have seen substantial supply side recovery which has eased core inflation, we do not think that with food inflation remaining at 7 or 8%, the Reserve Bank of India can afford, to sound less hawkish or dovish just yet. Look, they have already breached their legislated inflation mandate once in 2022, even though under extraordinary economic circumstances, they would still tread very cautiously because they want to reinforce their inflation target at 4% and they don't want inflation expectations to become unanchored. So just for the sake of perception and for the sake of being cautious, I think they will wait a bit longer.
And what's the current forecast then for when you think they might be able to change their monetary policy?
So currently we are hoping that it is in June that they change their stance to neutral from a hawkish stance currently. And it is in August that they deliver their first rate cut, and a cumulative 100 basis points reduction in the policy rate over the oncoming rate cutting cycle.
And is there another way that the Reserve Bank of India can reduce some of the pressure on the economy but not necessarily cut interest rates? For example, is there some things it could do in the bank liquidity scene?
Interestingly, yes. And we do think that the Reserve Bank of India may be expressing its comfort with how inflation is broadly evolving through the banking liquidity route. So if we take a step back, we know that since Q3 2023, the weighted average call rate or the call money market rate has been above the repo rate, about 10 to 15 basis points for so long, because the Reserve Bank of India was being overly cautious in the face of a food price shock and when monetary policy transmission had slowed. But what had happened in the recent months is that this tightness was starting to spill over into other asset markets because the call money market rates were too tight, and that was leading to some tightness of financial conditions which the Reserve Bank of India may not have liked, because that may have been hurting the productive needs of the economy. So now that they are broadly comfortable with how inflation is evolving, food inflation is also coming down, I think they are keen to have a narrower liquidity deficit and keep the weighted average call rate or the call money market rate at the repo rate, which would mean that there is a bit of a de facto easing of financial conditions.
Just finally, why do you think that surge of food price inflation, which, as you say, is so important in spending for consumers in India, why hasn't it flown through into a second round effect, into a higher expectation for core inflation?
Again, we suspect various reasons behind it. The first reason is that, look, inflation expectations have themselves been easing, which means that the channel through which second round effects occur is itself weakening. And more importantly so, India has a large informal labor market where employers tend to have a larger influence on wage setting and wage growth than the employees. And it is business inflation expectation which look very well anchored with the Reserve Bank of India's forecast, also reflecting the success of inflation targeting regime, which matters more for the second round effects. Basically saying that because businesses expect the current inflation shock to be transient, it hasn't really spilled into higher wage growth and therefore second round effects. So I think overall also the growth dynamic of the economy has been non-inflationary in the sense we've seen a substantial supply side recovery amidst private consumption weakness.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 12th. Catch you tomorrow with the latest on those key US inflation figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.